Welcome, everyone. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you so much for joining us tonight to talk about private markets. And tonight is really an educational type of webinar. You know, we always try to educate and talk about what we all can learn about investments, but tonight is particularly focused on purely learning. In fact, we call it a private markets masterclass. We do have a kind of a master teacher tonight, which is Hamza Azim, who's a managing director at Hamilton Lane. Hamza, thank you so much for joining tonight, and I'm looking forward to your session. Now, before I let you take the stage, Hamza, let me clear out a couple of things. First, for all the participants, if you have any questions, please use the AMA function on Zoom or the comment section on YouTube. At the end of Hamza's presentation later, we'll try to go through as many questions as possible. I can't guarantee we're going to go through all of them. There's a lot of you here, but I'll do my best to go through as many as I can and to kind of summarize as much as possible. Okay. Now, before we jump into it, let me do a quick intro from a StashAway perspective. And tonight, again, we're talking a little bit about three areas of private markets, right? Equity, credit, and infrastructure. But let me make a step back and remind everyone what we offer overall as a platform. And there are currently, clients from Singapore, from Malaysia, from Thailand, from the UAE, and from Hong Kong logged in today for this webinar. So there are some, changes. As you can see, there are some flags on display here to show what products are available only in Singapore or only in Singapore and Hong Kong for the time being. We offer, cash management suite everywhere. We offer core portfolios, which is what we launch with. That's kind of what we're known for, managing diversified portfolios across asset classes. We offer thematics exposure, and we offer alternatives exposure. And alternatives, we started with private equity and venture capital in the traditional way with closed-end funds a couple of years ago, as well as angel investing with a partnership with XA Network. And then more recently, we launched private equity, private infrastructure, and private credit semi-liquid products. I cannot speak in detail about those products today because this webinar is available for non-accredited investors. But if you have any questions about any of these alternatives, which are only available for accredited investors, please do reach out to us and in general to my colleagues. I'll leave the page with phone numbers and names later on through the presentation. So tonight we're focusing thematically on these three areas: private equity, private infrastructure, and private credit. As I mentioned, we're not going to talk about the three products we offer. We're going to just talk about the overall exposure, the market, and with a very educational angle. So again, we're not going to pitch you anything. We're just going to talk about how to think about it from a personal portfolio management perspective. Overall, why should you think about private markets? And again, private markets, as of now, in the markets where we operate, are only available for accredited investors in Singapore, professional investors in Hong Kong and the UAE. And if you are an accredited investor or a professional investor, so if you are a high net worth individual, why should you think about it? I'll let Hamza go into much more detail later, but at a high level, there is impact on returns, there is impact on risk or volatility, and there is a very large impact on diversification, so on overall risk of your portfolio. So not only there is an impact on risk of the specific investment, but there is an impact on the overall risk of your portfolio through broader diversification. If you look at institutional investors, your Temasek and GIC, your Harvard endowment or Yale endowment, on average, they invest 23% of their portfolios to alternatives. Obviously, when you look at private individuals, high net worth, that number is much lower. I think for many people, that's actually 0%. And that's driven by two factors. One is that historically it's been difficult to access it, and obviously StashAway is there to make it easy. And secondly is because of lack of knowledge, which is why we spend so much time talking about these topics and trying to educate. Yeah. The way we design our product is we might try to make it simple and cost-effective to invest in the best private markets proposition available. The three products I mentioned, private equity, private credit, private infrastructure, they are semi-liquid. What that means is that even if they invest in illiquid assets, private equity is obviously illiquid, the way the funds are structured allows for some liquidity to be there. So we give a 1 year no withdrawal rule. And then after that, there is actually possibility for monthly liquidity with some gating. So in normal conditions, you should be able to actually withdraw in any given month. There is also low minimum investments. So the minimum for our private markets product is $20,000, and additional commitment can be as low as $5,000. This compares to $100,000 plus for the private banks today. It used to be $500,000, now it's 100,000, 125, 250. So $20,000 for diversified exposure. So this is the way we built the proposition is making sure you have diversified exposure, even if you invest only in one private equity or private credit or private infrastructure fund. I'll leave this on for a second, which is who you can talk to in Singapore and Hong Kong to talk about those private markets product, or broadly speaking, about StashAway. So I'll leave this here for a second. Obviously, if you fail to capture this, just write to us at support@stashaway.com, and somebody will reply to you, or simply write in the chat or a question here, and somebody will reply to you. Otherwise, Hamza, I will thank you again for being here, and I will pass the microphone or the baton to you so you can actually share your screen so it's easier for you to click away through your deck. Okay?
Perfect. Thanks, Michele. Great to be here. And again, thank you everyone for joining. Appreciate it's late in the evening for most of you. I will just share my screen. Okay. So we've got lots to go through today. As Michele mentioned, this is meant to be an educational session. So we're going to talk about what are private markets, what are some of the different investment strategies that you can think about when it comes to private markets, how do they compare to their public market equivalents, why as investors should or should not consider having private markets within their portfolio, what are the different access points when it comes to private markets, what are some of the evolutions that have happened in the market to make the asset class more accessible to the wider investor base, as Michele touched on a few of the things. So lots to go through, and I'll be mindful of time here, but hopefully we can address most of the questions that we have towards the end of it. So first,
one quick thing. Sorry, Hamza, one quick thing technically. You're not sharing the presentation view, so it's a bit small. I don't know if it's so it's we
second it is full view at mine.
Yeah, no problem. Yeah, we're seeing the classic PowerPoint view with the not the presentation view.
Is it any better now or no?
No, if you might want to, assuming you're sharing the right screen, on the bottom right, if you click on just before the zoom, there is I don't know how you define that. Just before the zoom, the bottom just before the zoom, that should actually help. I think you're sharing the wrong screen. That's why you're sharing if you have two screens, you're sharing the wrong screen. That's why.
Give me 1 second.
Yeah. Yes. Perfect. Yeah, now it's perfect. Actually, not anymore. It used to be.
It's okay?
Yes, now it is. Now it is. Yes.
Super. Apologies for that. So here you see a number of different investment strategies all across private markets. Again, names, terms that you would have seen being used in different contexts: buyout, venture growth, credit, real assets, etc. Now, what are each of these? And again, apologies if some of you are already familiar with a lot of these terms, but just for completion, we will go through them 10 by 10. So firstly, when it comes to buyout, again, it can vary across sizes. It can be small, mid, large cap, mega cap, but essentially these are equity investments where a company is being acquired. There typically is some use of leverage, and these are typically mature, cash generative, performing companies. Next is venture growth. Again, somewhat similar, but you're going in earlier in the life cycle of a company. So think about it in the startup world, early stage investments, in a lot of cases, technology-based companies that are just starting off with a new idea, with a new venture. So again, you're going in as an investor in the company, but a lot earlier than what it would be in the buyout space. Third one is credit. As the name suggests here, instead of going into the equity of the asset or within the capital structure, you're going higher up in the capital structure and investing in the credit. So essentially providing a loan to the company. And again, we'll go through it in a bit more detail. Based on seniority, there can be different risk profiles, but instead of the equity, you're going into the credit or loan of the company. The fourth one is real assets. Again, here, as the name suggests, these are investments in physical assets. So if you think about it, it can be real estate, so office buildings, commercial buildings, residential buildings. It can be infrastructure, which can be sort of transport linked, data centers, natural resources, and so on. So again, different parts, all privately held assets. None of these are publicly listed, but you could be in performing companies, you can be in early stage, you can be in the credit, or you can be in any of the real assets. Now, with regards to the accessibility point for each one of them can also be different. And here you see three key terms: primaries, secondaries, and direct investments. First and foremost, what are primaries? Primaries are essentially you as investors committing capital to a fund. So a fund that invests in, say, buyout, or a fund that invests in private infrastructure, you're committing capital to the fund. The fund manager then goes, and again, we'll look at it in a bit more detail, goes on to make investments in either buyout assets, credit assets, real estate assets, or so on. The second one is secondaries. Instead of committing to primaries, these are typically investments where an existing investor is selling their stake in the secondary market. So say you're a pension fund, you already have exposure to private markets through a number of different funds, a number of different primary strategies that you have. You want to get some liquidity back. You go to the secondary market to sell that exposure, and there's other buyers who can buy them in, again, as the name suggests, the secondary market. And typically, because you as a buyer are acting as a provider of liquidity, early liquidity on these assets, you're typically able to buy these assets at some sort of a discount relative to the holding value of those assets or funds. And then last but not the least is direct investment. These are investments where you're essentially co-investing alongside the private equity manager or private credit manager directly into the asset. So instead of a primary commitment, which is to the entire fund, you're directly investing in the asset alongside the manager. So again, these are terms we will look at in a bit more detail, but at a high level, different strategies and different accessibility points across the market. If you think about the asset class overall private markets, it's grown. It's grown significantly both in size and in complexity. Again, this is just a visual to show you where it was 20 years back in terms of size and where it is 20 years on today, both in terms of size as well as number of strategies, number of funds, number of structures. So it continues to grow, and therefore, as investors looking across your portfolio, it's important to understand if there is space for an asset class like this within your wider portfolio construction. So we'll talk, as Michele mentioned earlier, in a bit more detail on what is private equity, private credit, and private infrastructure, and then talk about accessibility points as well. So starting with private equity. So what is private equity? As the name refers to, it's investments that are made in assets that are not traded on a public exchange. They're typically harder to get access to because if it is a publicly listed stock, you can just go and buy the stock. It's not quite the same in private equity. You typically access them through funds. And given the complexity, given the nature of how private equity investments work that we will look at in a bit more detail, and the size of the investments that have historically been required, it historically has only been accessible or predominantly been accessible to an institutional investor base. We will see later how that has changed. You also see how the growth of a dollar has looked like both in private equity relative to public equities over the past. And what you see is from a performance standpoint, you do tend to outperform in private equity as an asset class. How does it work? It is pretty straightforward. The way it works is initially a private equity manager acquires an asset. Similar to buying any asset, there is negotiation, there is structuring, there's use of leverage. It then goes through a value creation phase. That can be 3 years, 4 years, 5 years, 7 years, will vary across different assets. And that is the period when the manager is bringing about changes to increase the profitability of the asset, whether that be to change the executive team, whether that be to change the financial structure of the asset, whether that be adding new sites, cutting down on costs, increasing the offerings, increasing geographies, so on and so forth. Whenever that value creation phase gets to the point where the asset is seen as ripe for sale is when an exit happens. Now, the exit can happen to another strategic buyer, i.e. another company buying the asset, which is complementary to this business. It could be another private equity player buying the asset. If the asset is large enough, it could potentially go through an IPO as well. So again, one of the things to keep in mind is off and on, it is thought that the only exit route for these assets is IPO. It's worth highlighting that it's not the only exit route, and there are many other exit routes that can be utilized for these privately held assets. Now, I think this slide is an important one because it compares the size of the universe for private assets relative to publicly listed companies. And it looks at it across different geographies, North America, Europe, and Asia. And here it shows you the percentage of companies that are publicly held versus privately held in each of those geographies. Slight variation in each of them, but anywhere between sort of 85 to 95% of the companies in each of the geographies are privately held. Now, what that means is for you as an investor, if you're thinking about a holistic exposure to a certain geography, it is important to consider exposure through private assets because that does form a bulk of the companies. And here you're looking at companies with revenues north of $100 million. So we're not talking about super small companies that we just call a private business. These are substantial businesses, revenues north of $100 million, and 90+% are typically privately held. So large enough sort of universe to pick and choose from. The other interesting thing that you see here is how value creation has shifted from companies being publicly held to companies being privately held. You look at something like Amazon, very little value creation happened when the company was privately held. A bulk of it happened post-IPO, which is the light blue section of the bar that you see here. What you see with some of the subsequent names, Google, Meta, Alibaba, and a lot more now, a significant amount of value creation happened while the company was still privately held, and little thereafter post-IPO. What you also see, and in the chart on the right-hand side of the slide here, is companies are being held private for longer, and they're growing to a much larger size before they go through an IPO. So once again, from an opportunity set standpoint, larger opportunity set plus the value creation being shifted for companies being publicly held to companies being privately held. Again, different private equity strategies. We touched on this briefly already. Venture and growth, early stage buyouts are typically when the asset is more mature, cash generative, and then you also have something further along the line. If it goes through a distressed period, there can be restructuring, revival, etc., and different sizes. So once again, I won't spend a lot of time on this, but the key point really being you can be even more specific based on where you want exposure, given the risk-return profile that you're looking for. So who invests in private equity? As I was mentioning earlier, and again, we'll come to this in a bit more detail later, while it is an asset class that performs well, that outperforms public equity with a lower volatility, it tends to be a nuanced asset class when it comes to the administrative burden of it, the day-to-day monitoring of it, and also the typical size that is needed for these investments. So historically, it predominantly has been an institutional investor base. Again, that is changing and we will spend some time on it. But this is what you see here, that by and large, what you see as the investor base for the asset class has been institutional. Let's dig a bit deeper into performance here, because again, across different market environments, you may get different views. You get lots of coverage in the media as well, different views. But here, what we look at is on the x-axis, you're looking at the public market performance. And on the y-axis, you're looking at the outperformance of private equity relative to public markets in each of those scenarios. So if you look at the extreme left, that is when public markets are down by 5% or more. If you look at the extreme right, that is when public markets are up 15% or more. Two key things to take away from this slide. Number one, regardless of what the public market performance is, and this is over an average of 4-year period, private equity tends to outperform public markets. And number two, that outperformance is at its highest when public markets are down. So two key takeaways from that. Number one, it is an asset class that outperforms. And number two, as a diversifier, as Michele was mentioning earlier on, in your overall portfolio, in your overall exposure, it is part of the market that tends to outperform public markets the most when public markets are actually down. So something to bear in mind when considering your overall portfolio construction. Moving on from private equity to private credit. Again, what is private credit? It's straightforward to understand as it's all in the name. Instead of going into the equity, you're going higher up in the capital structure and going in the credit, essentially providing a loan to the asset. The benefit of private credit, or what some of the typical features are that resonate well with investors that consider this part of private markets is the contractual yield. Because you're providing a loan, whatever the contractual coupon is on that, as long as the underlying company is performing and the loan is performing, you're able to get some steady state income from the underlying investments. And that means there's constant de-risking of your investment because on a regular basis, you're getting a steady cash flow. There also is some downside protection because relative to the equity exposure, you're going higher up in the capital structure. So in the event the company goes bust, you're right at the top of the capital stack where you have some sort of more protection. So lower risk, but that does come with a relatively lower return profile compared to equity. So really private credit, think sort of downside protection, contractual yield, steady state income, and lower duration compared to private equity. Now, private credit as an asset class has had a lot of attention over the last few years, and year on year, we continue to see it grow. Now, why is that? I'll go through both the theoretical side of it and also more of the numeric side of it. If you think about the numeric side of it and focus for a minute on the chart on the bottom of the slide here, you look at the light blue line, which is the capital available in the private equity space. And then you look at the bars, which is in the private credit space. Typically, if you think of a leveraged buyout transaction or a private equity acquisition, at a high level, think 50% is funded by equity, 50% is funded by loan or credit. So you would expect the two markets to be at par with each other in terms of size. However, what you actually see is there's a gap of about $1.2 trillion between those two markets. So there's huge room for growth for private credit to fill that gap. And that is why we continue to see private credit as an asset class grow in size year over year. Also, relative to going through a syndicated loan, you're only dealing with one or a select few private credit players. And from a borrower's perspective, what that means that it's a longer term partnership. There is more confidentiality. There is speed of execution. There is certainty as well because it is relatively less impacted by fluctuations or market sentiment. And you can be more certain that if you're putting a leverage structure in place, if you need a certain amount of loan, rather than relying on the syndicated loan market, which can be very dynamic and can fluctuate significantly based on market sentiment. In private credit, you can have a little bit more certainty for the speed of execution, for longer term partnership, as well as, depending on the complexity of the transaction, having a select few partners that you can work with rather than trying to explain the structure to the entire market you're selling the loan to. So a number of different tailwinds that are supporting private credit as an asset class. Now, within private credit, there can be different levels of seniority that you can get exposure to. And again, the higher up you go in the capital structure, as you would expect, lower the risk and lower the return. So if you look at it right at the bottom, and I'll just focus on the left-hand side where it's just under the origination strategies here, right at the bottom is equity. Then it's preferred equity, then mezzanine debt, then second lien debt, and then senior debt, first lien or unitranche. So depending on what your risk return profile is, you can get access to different levels of seniority within a private credit. And if you look across the market, you will have funds that are focused more purely on senior credits, so sitting right at the top of the capital stack, some that are more opportunistic credit, but more opportunistic, more equity-like returns, but naturally that comes with a slightly higher risk. Similar to how we looked at return for private equity, if you look at the return profile of private credit, what you see is it consistently outperforms its public market equivalents. So here, the light blue dot shows you the public market equivalents. The dark blue bars are showing you private credit. And what you see is over the last 2022 vintages, consistently private credit as an asset class has outperformed its public market equivalent. Another thing worth highlighting is the dispersion of returns. Because yes, fine, year on year, you had that consistent return. But if you look at the dispersion of returns across different managers within the asset class, what you see is for private credit, the dispersion of the returns, both in an up market as well as in a down market, is significantly lower than all the other strategies, be it buyout, be it venture, be it real estate. So once again, from an asset class perspective, as I was mentioning earlier, it is one that focuses on steady state yield and safety. And what that means is a consistent return profile, as well as a narrower dispersion of returns or lower volatility relative to some of the others. Moving on from private credit to real assets. In real assets, as I was mentioning earlier, three key areas: real estate, infrastructure, and natural resources. In real estate, here you see a nice photo of our head offices in Philadelphia, but it could be any real estate. It could be office buildings, residential buildings, so on. Next, infrastructure, you can have social assets, things, schools, parks, municipal buildings, economic assets, communications, power, energy, waste and water treatment assets, and so on. And then natural resources such as agricultural assets. All of these are under the umbrella of real assets. And again, depending on the risk return profile, depending on your views on the market, you could get access to each of these areas through different strategies within infrastructure. I touched briefly on this already. So economic infrastructure, think assets in the transport space, think energy. These are typically assets where the user pays directly for the services provided, and more often tend to be privately held. The other end of the spectrum is social assets. Again, think education, think some of the other areas where assets, and these are assets where governments pay directly for them and are provided either on a subsidized basis or through taxes. And these assets typically tend to be held publicly. So what we're really focusing on here is the economic infrastructure, because these typically tend to be held more privately. A few of the sectors, and again, these are all things that all of us encounter and come across on a day-to-day basis, but within the infrastructure umbrella, these are some of the key sectors that you get exposure to. So conventional power and energy, these are any power generation plants, oil and gas pipelines, storage tanks, and so on. You then have energy transition, quite topical, quite a tailwind for infrastructure as an asset class. And here, think about renewable power, so wind, solar, hydro, etc., EV infrastructure, energy storage, and so on. Next is transportation and logistics, so toll roads, airports, ports, railroads, etc. So any transportation and logistics infrastructure that you would encounter on a day-to-day basis. Digital infrastructure, again, another one, which is quite a tailwind for infrastructure as an asset class, given some of the transition that we are seeing, things like AI and the need for data centers, cell towers, distributed networks, etc. And then last but not the least, environmental, once again, a tailwind for the infrastructure as an asset class, where you're thinking about things like waste collection and processing, water treatment, energy from waste, or all of these things fall under the broader umbrella of infrastructure. You tend to see funds that will have a combination of all of them, or some that are purely focused on one or a couple of the strategies within the infrastructure umbrella. If you think about different strategies across infrastructure, similar to what we saw with credit, you have a whole spectrum. At one end of the spectrum, you have the core strategies. Now, these are core infrastructure assets that are long-standing, steady-state infrastructure assets, not much change to be brought about, not much value creation to be brought about. So think sort of toll roads, some oil and gas pipelines, where the revenue profile is heavily contracted. For the next X number of years, you will have a contractual yield on those assets, quite similar to a bond-like exposure, where you're not really looking for an upside or an equity-like return on it. What your return is, by and large, is essentially the contractual yield or the contractual revenue stream that is coming from the assets. The other end of the spectrum is your opportunistic assets. Now, these are assets where there's few or no contracts at all. It's more equity-like exposure with significant upside potential. And then somewhere in the middle, you have what we refer to as core plus and value add. Again, core plus has some features of core assets where there is some contractual yield, but still a little bit more of an upside. Value add somewhat between the core plus and the opportunistic, where there's a lot more value creation that can potentially happen and be additive to the value of the asset. And as you would expect from a risk-return standpoint, in the core assets, lowest amount of risk, and the return being the lowest or more conservative, while the opportunistic had the highest amount of risk, but naturally then a higher upside potential as well. Now, why private infrastructure? What are some of the key features for private infrastructure that make it attractive as an asset class? Firstly, it enhances the portfolio's risk-adjusted return. And the reason it does that is because the correlation it has to public equities is significantly lower. So adding private infrastructure to an overall diversified portfolio means you improve your risk-adjusted returns. And it also does that with a significantly lower volatility relative to what you would experience in, say, public equities. It also tends to be seen as an inflation hedge, or protection against inflation, because a lot of these contractual revenue streams are linked to inflation. So in an inflationary environment, your revenue stream will naturally elevate because the contracts are structured as such. So a number of different factors that make private infrastructure an additive to an overall portfolio. Once again, looking at it from a correlation standpoint, there's lots going on this slide, but I only highlight a couple of things. If you look at the annualized return for private infrastructure in this table, that's about 9.8%, not too different to what you've experienced in public equities. But if you look at the annualized volatility that private infrastructure has experienced relative to publics, it's a fraction of that. So you get an equity-like return with a significantly lower volatility. So that was on private equity, private credit, and private infrastructure. Next, we look at why to invest in private markets. We saw this briefly in the previous slide as well. If you look at the growth of a dollar over the past, what you see is private equity tends to outperform this public market equivalent. In this case, we're looking at S&P 500 or MSCI World. In both cases, private equity outperforms. Similarly, private real estate, private credit tends to have a more steady performance over a period of time. Here you look at the 10-year asset class performance for equity, for credit, as well as real assets. And in real assets, we are splitting infrastructure and real estate. What you see is both for private equity and private credit, which is the dark blue bars, you tend to outperform the different public market indices you can look at. Now, again, benchmarking is important, and that outperformance will vary depending on which benchmark you're looking at. In real estate, real assets, what you see is infrastructure tends to outperform its public market equivalents. In real estate, you do see the returns have been weighed down, and that is predominantly influenced by funds in the GFC period. But overall, private markets as an asset class has continued or shown consistent outperformance relative to public market equivalents. Now, this is an interesting slide because here you look at the highest 5-year annualized performance as well as the lowest 5-year annualized performance. And what you tend to see is, again, the dark blue bars as private markets, so equity and credit, and the light blue bars is public markets. And what you see is both in the highest 5-year period as well as in the lowest 5-year period, private markets, be it private equity or private credit, is outperforming public markets. Now, of course, things like venture growth are more high-octane strategies and they will be more volatile. But if you're looking at developed market buyout, it can, even in the lowest 5-year annualized performance, both in the equity space and credit space, you ended up with a positive performance. So while private markets, some may perceive as a high-risk strategy, if you look at the actual numbers, if you look at the actual lowest 5-year annualized performance, it's still better than public markets and it's still positive. So to recap this section, why invest in private markets? It potentially outperforms public markets with a lower volatility and lower correlation to public markets. It limits the drawdowns, as we saw in the lowest 5-year scenario, and overall, it adds diversification to your portfolio. Next is accessing the private markets. And as I'd mentioned earlier on, historically, it's only been accessible to the institutional investor base because high minimums, long lockup periods, the administrative burden, and so on. Typically, the way a traditional private markets fund works is that the fund manager goes to fundraise, gets commitments from a number of different investors. The close for the fund happens and an investment period commences. This is the period when the manager will be calling capital from those investors that made commitments, making underlying investments. Eventually, when investments have been made, they've had chance to grow, comes the harvesting period. This is when investments start exiting, and as exits are happening, distributions are going back to the investors. And this can be a period overall anywhere between 6 to 10 years. So initial commitments, investment periods, and then the capital coming back to the harvesting period. So it can be a long lockup period, a long wait till you get your money back. And what that leads to is what is typically referred to as the J curve in private markets, where you have initial period of capital calls or early negative returns, there's large minimum commitments to be made, and eventually you get your distributions back, so you're limited in terms of the liquidity you're getting. The administrative burden of capital calls, the high minimums that are required to invest in these funds, and the long lockup period. And that has given rise to evolution in the market in the form of what Michele mentioned earlier on, the evergreen funds. So how do these evergreen funds compare to a traditional private equity fund? Firstly, from a capital deployment perspective, as opposed to a multi-year commitment period where you're waiting for the capital to be called by the manager, whatever you're committing on day one is fully called upfront on day one. So you're going into a fully deployed portfolio day one, not waiting for your capital to be called. The minimum amounts that are required to invest in these funds are significantly lower than what it is in a traditional private equity fund. Again, Michele mentioned some of those numbers. Typically, in a traditional private equity fund, the minimum amount required to invest is 5 billion or higher. So overall, it's increasing accessibility and it's reducing the administrative burden that comes associated with the traditional private equity funds. From a liquidity standpoint, this still is an illiquid asset class, and you should still think of it as a long-term investment. However, in a traditional private equity fund, there typically is a 10 to 12-year lockup period. In comparison, in these evergreen funds, there's some level of liquidity available. In some funds on a monthly basis, in some funds on a quarterly basis. There's typically a cap at how much of liquidity is available, but at least there is a way out should the need arise, because these have been structured keeping in mind the private wealth investor base, where a life event may happen or there may be a need for liquidity, so there should be a way out for them. Diversification is another key point, because these funds tend to be a lot more diversified relative to traditional private equity funds. So you're getting a more holistic exposures to private market as an asset class. And then last but not the least is dynamic asset allocation, where in a traditional fund, you're committing to a specific strategy, in some cases, even specific sectors or specific geographies. While in evergreen funds, because you're constantly deploying capital on a regular basis, you have the ability to tilt between different parts of private markets, taking advantage of any market-driven opportunities that may arise. I'll wrap up here with where we are with our journey of the Evergreen platform. We've been in the Evergreen space for over 6 years now, across different strategies in private equity, credit, infrastructure, and a few more in the making. Over 11, and SaaS actually number is now close to $12 billion across our Evergreen platform. So mindful of time here, so with that, happy to hand it back to you, Michele, to wrap up and then perhaps have questions.
Thank you so much, Amjad. It was super interesting. I hope it was interesting for all the people. I see that the number of people on the webinar has been pretty steady, so it looks like people have been engaged. As a reminder to everyone, if you have any question, please use the Q&A button. I will try to go to as many as possible. But maybe, Amjad, let me start from a high level portfolio logic. So, I listen to your presentation and I see the returns, and I look at private equity overperforms public markets, private credit overperforms kind of the bond market in any shape or form, both risk adjusted and not. Private infrastructure is a great addition to that. Why should I not think, a bit provocative here, why should I not think about putting 100% of my money on private markets? Or should I?
Yeah, no, that's a great question. What I would say is private markets a replacement for public markets? No, it's not. Is it the same level of liquidity that you have in public markets? No, it's not, right? It's a complementary exposure. It is something that should be part of the overall portfolio. It should still be thought of as a long-term investment, because if you're looking in public markets, you could go in and 3 months later decide you need the liquidity back and get out of it. In these sort of funds, you should still think longer term, because even though there is some liquidity available, it is a long-term asset class. You should think of it as putting the capital away and forgetting about it, knowing that there is a way to get the liquidity, but think of it longer term. So I would say I'll never say it's a replacement for public markets. It's complementary to public markets, and both should be part of the portfolio.
I understand. And look, maybe doubling down on this, and it's difficult to be generic, but let's try. So you guys work a lot with family offices and endowments and kind of institutional investors and help them build their private market strategies. How, as a private investor, think about me. I'm a private investor, and I have a set of money. And I need to make two decisions here. One is how much of my overall money should go into private markets. And when evergreen and semi-liquid were not available, the answer would really go toward liquidity. Now that these funds are quite liquid, that becomes less of a constraint. So how do I think about what is the total allocation I should have for private markets? And then how do I think about within private markets? How should I think about private equity versus private credit versus infrastructure? What is the way to think about it?
Yeah, so I would say it goes back to sort of the portfolio theory. And if you think about how the whole 60-40 started, right? And the whole purpose of it was to have a diversified exposure across equities and fixed income and two uncorrelated exposures, right? So I would say, is there a magic number where every single investor should have, say, 20% of their investments in private assets? No, it's not, because it really boils down and comes back to what is the risk return profile and the liquidity profile that the investor is targeting. So I would say each scenario is bespoke and it should be looked at in line with what the investor is looking for, how much liquidity do they need in the shorter term, despite the evergreen nature of the fund, and what is their investment horizon. And then decide what is the right level of sort of private market exposure they need. To your second question, in terms of the split across different strategies within private markets, I would say, and again, it's probably not a helpful answer, but it really depends on the investor. We have investors that, for example, all of their private market exposure is purely venture growth, which is one end of the spectrum. We also have investors where all of their private markets exposure is senior credit, right? Because they want safety and yield. Others have more of a sort of ambitious return target, more longer term, and they want to go to the other extreme. A more balanced approach, I would say, would be to have some combination of private equity, credit, and infrastructure, because each of them are offering different features. You do want some safety and yield, you do want some equity-like returns, and you do want something which gives you some sort of uncorrelated returns to the other two, as well as inflation protection.
Okay, understood. Thank you. So there are a bunch of questions that came in from the audience. Let me address Jason's first. So Jason, you asked a question that is specific to a fund, so we're not going to be able to answer that question specifically, but I'll try to make the question a bit more general so that we can talk about more. And the reason, Jason, I cannot speak about this specifically is that there are non-accredited investors. There might be non-accredited investors in the call, so we cannot speak about the fund specifically. Now, the question, Hamza, is around private credit, in general, and the recovery process for defaults. So in the case of a borrower defaulting on a loan issued by a private credit fund, how does the process work for recovery, restructuring, and who is responsible for that? Maybe if you have any statistics on what the recovery process is, and maybe what is the default rate on first lien. I know he's talking about first lien specifically.
Yeah, so I would say in terms of first lien, you're obviously, the higher up you go in the capital structure, the lower the default rate. I can speak for ourselves. So for Hamilton Lane, on first lien debt, the default rate is actually 0%, knock on wood. Now, this is not to say that a default can never happen, but that is where we are right now. With regards to the process, I think it's a fairly, it can vary based on individual investments and what has been agreed, but it is something that is not a new process for the industry. It goes through, it's a whole legal process where there's legal involvement from both the sides to work out a plan of either restructuring the debt or to essentially liquidating the asset and generating the cash flow, and then goes through the waterfall. So if you're in the senior-most part of the capital structure, you get your money back first, then the junior debt, then the equity. So I would say it's a highly structured legal process, which is well set out and has been tried and tested a number of times across the industry.
Perfect. And maybe double clicking on this, there's another question, actually two questions from anonymous attendees on, again, risk. And so one of them ask if there is a credit rating for private credit evergreen funds. Yeah. And so maybe I'll drop it there.
Yeah, there is no credit rating because these are privately held assets, so they won't be like public assets where there is a credit rating.
Okay, and then the second question, which I guess applies to both private credit and private equity and potentially infrastructure as well, to be honest. I'll read it and maybe try to interpret it. So the question says, may I know how to handle the risk that the invested company goes bankrupt? Any gatekeeper for that risk? I think you talked a little bit about private credit, like there is a default on the loan, and you talked a little bit about the restructuring process or the recovery process and how that works. But let's maybe make a step back and think about the diverse risk on private equity, private credit, and think about that.
Yeah. So I think the key thing to note here is how concentrated your portfolio is, right? Because if I look at some of the evergreen funds, you're looking at number of positions that are 200 plus. If you look at the number of underlying companies that are 2000 plus, right? So if your portfolio is that diversified as an investor, you may not even necessarily see that if there is a default. Now, of course, that will be based on the level of disclosure, etc. You will be able to know that so-and-so asset has been marked down to zero because that has gone through a default, and from an equity perspective, there's nothing left in it. But it all boils down to how diversified your exposure is. And that's why with some of these evergreen funds being so heavily diversified, from an investor perspective, where this might be your only exposure to private markets, it's beneficial to have that widespread diversification.
Yeah, no, thank you. And this is very important. And it's actually one of the things I talk about a lot when I talk specifically about our three funds. Again, I'm not going to do it now, but the way we thought about the program is exactly this. How do we ensure that we provide with single funds, so single private equity, single private credit, single private infrastructure, a very diversified exposure through a sort of multi-manager approach. And that's the way we thought about it. So I agree on the logic of diversification, of course. Let me see. Oh, there is a question from one of the okay, there's a question from one of the YouTube, from Mark from YouTube, says, with the US universities trying to liquidate their private investment holdings, how does that impact the private equity sectors and the valuations?
Yeah. So when you think about whether it's universities, whether you think of pension funds, any other institutional investors that are rebalancing their portfolios, when it comes to private markets, that is where the evolution of secondary market has come about, right? You think back to a year like 2022, when public markets were down significantly, a lot of the institutional investors ended up being overexposed to their private markets, and they were coming to the secondary market with portfolios to sell them. Similar, if you think about US universities rebalancing their portfolios and essentially trying to sell some of that, what it does do is it brings more supply to the secondary market. If you look over the last few years, the supply in the secondary market has consistently been higher than the demand. And what that leads to is discounts at which you can buy these assets. So I would say the secondary market is becoming a bigger and more important part of private markets overall. And yes, things like what you saw from the US universities does get more media attention. That is not the only segment of the market or only investor base that is utilizing the secondary market. There are many others, and the market continues to mature and become more sophisticated and more transparent when it comes to pricing of these assets.
And when someone invests in an evergreen private equity funds, for example, is a portion of that going to secondaries market or not?
Yeah, so I would say it varies across different funds. Typically, we tend to think secondaries are an important part of these evergreen funds. The reason for that is it gives you two key things. Number one, it's diversifying your portfolio even more, because instead of just taking single name exposures, if you're buying portfolio of assets through secondaries, it's making your portfolio more diversified. The second thing is because you're going slightly later in the life cycle of the assets, the duration of these assets is shorter than your direct investments. That is an important feature for evergreens because remember, you're generating liquidity in an otherwise illiquid asset class. So these slightly shorter duration assets are important for steady state generation of liquidity. And then the discount, I would say the discount should be seen as cherry on top of the cake, which is not the only thing that is driving the return of the assets. These should be quality assets where there's future upside available. But because you're essentially acting as a provider of liquidity by buying them early on, you are able to typically crystallize some discount, which is additive to the return as well.
Understand. Thank you. There is a question on currency. Let me frame it. And so the question is, as investments might be in US dollars, how you manage the currency risk. For example, the US dollar has depreciated a lot in 2025. And that's all true. Now, how do you think, from an investor perspective, how do you think about currency exposure for private markets? Because obviously the US is a gigantic part of global private markets.
Yeah.
And how do you think about that?
Yeah. So I think currency is an important risk to consider from an investor perspective, especially if the base currency of the investor is different to the base currency of the fund. From our perspective, most of our funds that we see across the board are dollar-denominated funds. The base currency of the fund is in dollars. And the assets, because North American market is the largest and deepest when it comes to any part of private markets, that is the biggest exposure that we have in them. So we don't have a currency mismatch there. Now, if you're an investor that is coming into the fund, what we do see across the board, and we have it in our funds as well, is we do have share classes in other currencies that are partially hedged. So we would typically target a hedge ratio of anywhere between, say, 70% for equity and infra strategies, 90% for credit strategies, where we are hedging from the base currency of the fund, i.e. US dollar, back to the currency of the share class. From an investor standpoint, we see two approaches. One approach is that investors go for one of these partially hedged share classes. The other approach is they see it as part of their overall US dollar exposure, right? Yes, over the last few months, dollar has weakened significantly. That hasn't been the case over the last few years, right? So we could take a view on the currency, and people may have different views on the currencies, but overall, some investors tend to just go into these funds in the base currency, say US dollar, and just see that as their overall exposure.
Yeah, maybe if I can add something from my perspective, because you need to think about private markets investment as long-term investments, even when investing semi-liquid, as you mentioned earlier, reality is that it's very, very difficult to predict currency movements. Next month, imagine next 5 years. And so you're right. I think the best way possible is to actually think about it as your, part of your overall portfolio, and that's your US dollar exposure as part of your portfolio if you're investing in US dollars. And you always need to look at what's inside the fund. As mentioned by Hamza, the deepest and largest private markets in the world are the US by a distance, and so it's difficult to invest broadly in the markets without having some sort of US dollar exposure, unless you hedge, as mentioned by Hamza. Okay. Let me just check. I had one more question that I wanted to ask you, and sorry. So there is a question from Michael asking, I'm 57. Is it advisable to make this private credit investment? So let me maybe answer that. I don't want to put you on the spot here. So obviously I can't provide, investment advice, Michael, here. You're more than welcome to talk to one of our wealth advisors and reach out to us. So I'm not going to speak to you, but broadly speaking, at 57, maybe you're approaching retirement or you're thinking about retirement. Reality is that you have ahead of you still a fairly long time for your fund. So depending on your overall portfolio situation, it might or might not make sense to invest in private markets. Private credit, that is the one you mentioned, is actually at the lower end of the spectrum of risk, especially if you're looking at kind of first lien. So it might make sense to look into it. But what you need to consider is your liquidity profile, and especially your liquidity profile over the next 10 years. So, you're thinking about stop working, you need yield coming in, etc. So private credit is a strong yield provider. So depending on your overall portfolio, it might or might not make sense. I would encourage you though to speak to one of our wealth advisors if you want to have an actual advice. Again, I can't, I don't know who you are and what your situation is, so I cannot be specific here. Yes, I wanted to ask you one last question on infrastructure, and then we can, I guess, close it here. So, as you know, we just launched private infrastructure in July. So for us, it's been a new product, and we saw an incredible amount of interest on infrastructure from our clients, probably more than I would have expected, and which is great. And so I want to ask you, how is the private infrastructure market developing? Is there a tailwind trend where governments are more in debt and therefore they need to sell their assets, and therefore there is more assets available, so how do you think about that from a macro perspective?
Yeah, I think it's a good question. I think infrastructure has seen tailwinds both from a sector standpoint as well as what the market has widely experienced over the last couple of years. So when we went through a high inflation environment, as I was mentioning earlier on, infrastructure is seen as an inflation hedge, and investors realize that there's need to have that within their wider portfolios. Should we experience an environment like this again, private infrastructure performed pretty strongly. The second thing, as you mentioned, Michele, is from a sector standpoint, if you think about things like AI, if you think about things like energy transition, if you think about things like waste management, all quite topical, all with a lot of investment, both from private investors, from governments, from across the board, they all boil down to some form of infrastructure. So I think both from an investor portfolio standpoint, as well as the key sectors that infrastructure has exposure to, are acting as tailwinds for infrastructure. And I would echo what you said, where the investor interest in the asset class has been significant over the last year or so.
Perfect. Look, Hamza, thank you so much for your time and for your knowledge and for sharing that knowledge. It was super interesting for me. I'm sure it was interesting for all the people that participated. To those that participated, also thank you for spending this 1 hour with us. If you have any follow-up questions, feel free to reach out to the StashAway team. I'm sure my colleagues will be happy to respond to those questions and address your question. Reach out to wealth advisors in case you are interested in learning more about our private markets offering. As mentioned, I cannot speak about it in detail today, but the wealth advisor will be able to do so. And if you're interested in private credit specifically, you can actually look at it directly on the app by yourself, and as well as talk to wealth advisors. So I will close it here. Hamza, again, thank you so much for your time. And I'm sure I'll see you again in a webinar or in a seminar. I always enjoy the sessions with you. And thanks so much also for my colleagues in the background that were kind of facilitating and answering some of the questions. Thank you so much, everyone. Have a good evening. Bye-bye.